Welcome to RBC's Markets in Motion podcast, recorded October 28th, 2024. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. 3 big things you need to know. First, the early S&P 500 stats are now pointing to a mildly disappointing 3Q24 reporting season so far. Second, a mixed backdrop, the need to wait longer for interest rate relief, and the need to get through the election were key themes in last week's earnings calls. Third, the U.S. election has been in focus in our recent meetings with U.S.-based long-only investors, who we've encouraged to be ready for all outcomes. If you'd like to hear more, here's another 5 minutes. Now let's jump into the details. Starting with takeaway number 1. The early S&P 500 stats are now pointing to a mildly disappointing 3Q24 reporting season. When we crunched the data late last week, here's what jumped out to us on the stats. The percent of companies beating consensus forecasts on earnings and revenues within the S&P 500 are now both tracking a little below 2Q24, coming in at 76% on earnings, down from 80%, and 58% on revenues, down from 61%. Meanwhile, Russell 1000 companies beating consensus earnings forecasts are underperforming the broader market in terms of immediate price reaction. Also, the rate of upward revisions for earnings within the S&P 500 has averaged just 42% over the past 4 weeks, pointing to mostly downward revisions to earnings forecasts. In dollar terms, the bottom-up consensus for S&P 500 EPS growth has also moved down to $242 for 2024 from $245 a few weeks ago. 2025's bottom-up consensus forecast on earnings has also come down a bit as well. Energy accounts for much of the softening, but other sectors are also contributing. Moving on to takeaway number 2, a mixed backdrop, the need to wait a bit longer for interest rate relief, and the need to get through the election were key themes in last week's earnings calls. As always, our team has been reading through earnings call transcripts. Last week, discussions of the outlook, macro backdrop, and business conditions remained mixed. Companies with a more positive tone highlighted healthy end markets, comfort in current trends, low unemployment, moderating inflation, stability in short-cycle businesses, a slowing but resilient economy, low recession odds, and robust deal pipelines. Companies with a more negative tone highlighted mixed end markets and macro indicators, choppier sluggish demand, consumer reluctance, economic softness, and a worse third quarter than anticipated. Geography, particularly China, became more in focus as sector representation broadened out last week. Companies emphasized ongoing challenges, uncertainty, and weakness in the market, along with optimism about the coming impact of stimulus, though on that, several noted it was early days. The Fed and interest rates generally remained very much in focus last week. Some companies were optimistic about the positive impacts of interest rate decreases, while others dwelled on the negative impacts of the high level of rates that remained in place. Several noted real relief here will simply take more time. Unsurprisingly, the U.S. election came up quite a bit, and there were numerous references to the uncertainty the event has created and its impact on business activity. Several companies noted the need to simply get to the other side. We took note of one company emphasizing that they'd be able to navigate regardless of outcome. We also found it particularly interesting when one company highlighted how their active adult buyers, this was a home builder, seemed most sidelined by the event. We'll wrap up with takeaway number 3. What else is on our minds? To start with, on sentiment, net bulls on the AAII investor survey fell to 7.8% last week, bringing the 4-week average down to 18.6%. For several weeks earlier this month, net bulls were more than 1 standard deviation above the long-term average on that 4-week average, a level associated with the start of 5 to 10% drawdowns in the S&P 500 in recent years. So the slippage we've seen here is actually a positive development for U.S. equities, to be sure. But it's also possible we've not yet fully experienced the full effects of sentiment, having briefly gotten too optimistic. We do remain on guard for another short-term pullback. Finally, the election has been in focus in our meetings with U.S.-based equity investors in recent weeks, a contrast with much of 2024, when most of these investors found conversations to be extremely uncomfortable on the topic. Our sense is that these investors aren't sure who will win and aren't sure what to do even when they know who will win, and really just aren't doing much right now. Concerns about a contested election or lengthy resolution are also top of mind, and these investors generally seem to us angsty and stuck. One question coming up has been whether financial markets are already baking in a Trump victory. While we wouldn't go quite that far, we do think some repricing for this outcome has started. In addition to a market that seems a little bit out of sync with reporting season, trading in the S&P 500, small caps, the dollar, and 10-year yields have all become aligned with Trump's odds in the betting market's polling average or both. If Trump doesn't win, these trades seem likely to reverse in the very short term. Longer term, however, we continue to believe that the thing that may matter most for U.S. equities is simply getting past the event so that companies and investors know what they're dealing with. One last thought. We know that the election is just a week away. Betting markets have expressed a view, and some corners of financial markets have started to adjust. But we are also mindful of a few other things. The polls are tight in the aggregate, but reflect deep divisions on many issues and in certain demographics. Turnout will be key and is tough to predict. And conditions will continue to evolve in the week ahead. We've been telling investors to go into next Tuesday prepared for all outcomes and wait and see how things unfold. And that remains our view today. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.